Hey, and welcome back to my channel. My name is Hannah and this is Learn with Miss Hannah. Thank you so much for watching my videos. Today we're going to look at IAS 8. So we're going to look at IAS 8 spells out accounting policies, changes in accounting estimates, and errors. So what shall we cover under IAS 8? Under this, you're going to look at the selection of an accounting policy, change of an accounting policy, change of an accounting estimate, and correction of prior period errors. So let's get right started. IAS 8 lays down the criteria for the selection of accounting policies and prescribes the circumstances in which an entity may change the accounting policy. What do you need to follow in order to select an accounting policy to use, and in which or under which circumstances may you change an accounting policy? That is what basically IAS 8 tells us. What you need to know, what you need to follow before selecting an accounting policy, and under which circumstances you might actually change the accounting policy that you are or you have been following. So IAS 8 defines accounting policies. We've been talking about accounting policies, change of an accounting policy. So what is this accounting policy? IAS defines accounting policies as the specific principles, bases and conventions, rules, and practices applied by an entity in preparing and presenting financial statements. So most of us have basically have probably seen the word accounting policies before. Actually all of us, because if by the time you're watching this video you have done financial accounting, so you have seen the word accounting policies before in financial accounting and you've defined it. However, in this case, the definition may differ from your definition, and this is the definition you're supposed to take. Most of the definitions are actually going to differ, like the definition of an asset, liability, expenses. Here they are more defined and more broad, and this is the definition you need to present. These are the definitions you need to present in your exams. So you need to take note of that. You need to be careful. So IAS 8 defines accounting policies as the specific principles, bases and conventions, rules and practices applied by an entity in preparing and presenting financial statements or financial instruments. So actually, before I go to this next step, you need to understand that the use of the word policies in this suggests that entities are allowed to choose between alternative accounting treatment. We shall get I'll throw more light on that as we continue. So some entities accounting policies will be dictated by international standards, which will permit no choice of treatment. So these are the examples we are looking here. When I say, for example, these are the standards that do not permit choice, of treatment. You have to follow the standard the way it is. You don't have the choice to change or based on your own, let me say, your own judgment. With these policies, with these accounting policies, you need to follow exactly what it says in the standard. So that is what I was talking about, that by the use of the word policy in the word, we have accounting policies. It suggests that entities are allowed to choose between an alternative accounting treatment. However, there are some standards that do not permit change in the accounting standard, in the accounting policy. They do not permit any choice. So, for example, IAS 2 of inventories, this requires that inventory should be consistently measured at the lower. This talks about measuring at the lower of value and net realizable, at the lower of cost and net realizable value, and this cannot be changed. You always need, I just mixed this up a little, just fix it. So measuring at the lower of cost and net realizable value. This is something you cannot change, and you need to follow the policy the way it is. So there it does not permit choice. And then we shall continue and go to IAS 37, provisions, contingent liabilities, and contingent assets. It also does not permit recognizing contingencies within the financial statements. This doesn't permit recognizing contingencies within the financial statements. I'll just write that statement. It doesn't permit recognizing contingencies within financial statements. You just, for example, let me give an example of a contingency. For example, you have a pending case in court, and you're not, maybe this case can actually affect the company financially. So since it can affect the company financially, you need to record it in your financial statements. But IAS 37 is telling us we do not recognize contingencies within the financial statement. So what do? You just write off this in the set of notes, in the notes to the financial statements, notes to the accounts, and that is where I disclose it off. You don't include it in your statement of financial position, your statement of comprehensive incomes, your changes in equity statement. You don't include it in any of the financial statements, the cash flows, but rather you disclose it off by word of note. That is for contingencies. And this, you do not have any choice to alter it or anything. You just follow the principle the way it is, the policy the way it is. And then we have IAS 38, intangible assets. Intangible assets prevents entities from recognizing internally generated goodwill. It prevents the entities from recognizing internally generated goodwill. In your financial statements, you're not supposed to include internally generated goodwill. I'm going to summarize that as financial statements. So you're not supposed to recognize internally generated goodwill, or also known as the inherent goodwill. Inherent goodwill, you're not supposed to recognize it in the financial statements according to IAS 38, intangible assets. So these are policies that do not permit any choice between the alternative accounting treatments. They do not permit any choice. But we also have some standards that do permit a choice. We have standards that do permit a choice, and these include, let's drag this down here. The standards that do permit a choice include IAS 16. This is property, plant, and equipment, PPE. This is PPE. So IAS 16 allows entities to measure items of PPE using either the cost model or the revaluation model. It gives a choice between use of the cost model or the revaluation, and the revaluation. So entities can either choose to use the revaluation model or the cost model while recognizing PPE. So IAS 16 provides that choice. It provides the choice to choose between those two. You can either use the cost model or the revaluation model while measuring items of PPE. Then we have IAS 38, intangibles. This allows intangible assets to be measured either using the cost or revaluation model. This is still same as IAS 16 PPE. So it still also allows a choice between the cost and revaluation model. And then we shall go ahead to look at, actually that is all for today. I don't know, I think I was just into the video, but that is all for today. And in my next video, we're going to look at selection of an accounting policy. So please don't forget to hit the subscribe button, hit the notification bell, and you'll be notified wherever you are about this video. When I'm done with it, when I upload it, you'll be able to know, and you'll be the first person to know. So please like the video, give it a thumbs up, drop something in the comment, tell me you liked it, or tell me where I can actually improve it, because I'm trying to make sure that you enjoy this video. So if you've not really enjoyed it, you can as well tell me in the comments and I'll be able to improve it.